Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's been going on in investment markets and what to look out for in the days and weeks ahead. Now, the start of this show, the title alludes to perfection, and that's because we saw something interesting in equity markets in the US last week. We saw a perfect week on the S&P 500, and by that I mean every day of the week we saw the S&P 500 close at a new 52-week high. It's an unusual event, and obviously it's something that's quite bullish and positive. And you will be perhaps not surprised, therefore, to hear that the S&P 500 was hitting new all-time highs, as was the Dow Jones, as was the Nasdaq. So equity markets in the US have been in a very risk-on mode. And so we had the pullback at the end of January, but we've rebounded strongly. And that's been reflected around the rest of the world to a certain extent, perhaps not so much in Europe. Now, the main driver behind that optimism has obviously been the hope of more fiscal and monetary stimulus around the world, particularly in the US. So that's been a positive driver for equity markets. As well, we've had earnings season that's been ongoing, and actually the earnings reports have been greeted with optimism from investors. They've been better than expected. So that has been another driver. Of course, in the background, we've got the coronavirus, and there are, of course, problems with the rollout of the vaccine, particularly in Europe. So despite that, there is still this bias towards the upside. So markets are very bullish. In fact, equity markets at the moment, almost across the globe, are in a very positive upward trend. It almost feels like what can happen to stop this momentum. And in fact, if you look at the US markets, S&P 500, Dow Jones and Nasdaq across the board, they've got some among the lowest levels of shorting, so people betting against the market, that we've seen in 17 years. And of course, the positive, like all-time highs that we're seeing in equity markets in the US, we're seeing similar feats elsewhere. I mean, the Japanese Topix is at a high, well, since 1991. It's at its highest point since that period, which is obviously we're talking 30 years. So we're seeing this upward momentum pushing higher across the globe. I mean, if you look at the emerging market indices, they have been pushing higher because we've seen a bit more weakness in the dollar. So the message for investors has been risk is being rewarded. So that means holding equities. And how long will that continue? That will be interesting to find out. Now, if you go across to the bond space, it's a different story. Gilts, UK gilts, if you look at the 10-year UK gilt, the yield is up above 0.5%. So that's on a level that we haven't seen since before the vaccine, or when the vaccine was first announced. We saw yields spike to that kind of level, but we've even surpassed the levels that we saw when the first hope and optimism surrounding the vaccine occurred. And don't forget, when there's optimism about the economic recovery, that tends to be bad for bonds, which therefore you see their yields rise. And another reason why we saw yields on the UK gilt rise is because the Bank of England, in their interest rate setting meeting, they announced that the idea of negative interest rates, something that people have been expecting possibly this year, that seemed to be pushed further into the future. So people could say that this was more of a hawkish meeting, a hawkish statement that was made afterwards. So the expectation of more monetary stimulus, cuts in interest rates, was priced out by the market. And of course, that meant that the yields on the 10-year gilt started to rise. So the message is that it's been a pretty poor time to hold bonds. In fact, bonds have not been doing so well because of the risk-on nature of markets at the moment. And of course, if you go to the US, the 10-year US Treasury, we got up to about 1.2% on the 10-year US Treasury yield. That is a level that we've not seen since the pandemic started over a year ago. So we're seeing yields pick up and rally, and that obviously is negative for any of the bond holdings that you have. The pound has been strengthening slightly, pushing above that $1.38 level. But it's also interesting to see what's going on in the commodity space, particularly gold. So gold has had a bit of a rough time. We fell back towards the 1800 level, broke below that, towards the 1750 level. That's going to be a key level for gold. If gold doesn't hold above there, that's at $1,750 per ounce level, then we could see the gold price crash. But if it can recapture its 50-day moving average, so around about 1850 and push higher, then we could see the price of gold recover, because gold has underperformed. The rebound we've seen in the last couple of days has been because we've seen the dollar start to weaken again. We saw it strengthen for a bit, but it's starting to weaken, which is also driving up the emerging market indices, the equity indices. So we're seeing what we saw at the beginning of January, we're seeing it start to repeat at the beginning of February. So that's a very risk-on environment. Interestingly, these days it seems that people can't talk about gold without talking about Bitcoin. And Bitcoin has rallied to new all-time highs. It does feel like we're talking about new all-time highs on a lot of risk assets at the moment. And that was partly because Tesla announced that they'd bought about $1.5 billion worth of Bitcoin, which therefore pushed the enthusiasm and the price of Bitcoin ever higher. If you want a snapshot of where the market is right now, I often talk about the fear index, the VIX, and that is obviously a measure of expected volatility on the S&P 500. Now, that, if you remember, about a week or so ago, towards the end of January, it spiked above 30, 31, which was a sign that fear was starting to drive the market. Well, in 4 days in the last week, we saw the VIX plummet, and it's now down to around about 21. In fact, the 4-day fall in that VIX, and meaning that fear was receding, was one of the biggest falls we've ever seen on record. So you can see at the moment, markets are very much on risk on mode. Investors are piling into equities, and it's driving your portfolios ever higher at the expense of bonds, which is typical when you see that dynamic between equities and bonds. And while we talk about a perfect week, it starts to ask the question, is, are markets priced to perfection now? Is all the good news already being priced in markets? Or is this the start of another leg higher in another bull market? So there's a lot to keep an eye on in the coming days and weeks ahead, particularly on gold, the equity indices, and do expect a bit of volatility in February. As I mentioned previously, February, the back half is notoriously a weak time for equity markets. It doesn't mean that history will exactly repeat, but if you're prepared and expect it to come, then if it doesn't, you can only be pleasantly surprised. So that is it for this week on Damien's Midweek Markets. As ever, you can contact me, Damien at moneytothemasses.com is the email address. Twitter, money to the masses with a number 2. You can find us on Instagram, you can find us on Facebook, and of course, don't forget to subscribe to our YouTube channel.